All right, so let's dive into the stock market today, and specifically how it's reacting to the latest economic news.
Yeah, always interesting.
You know, the December jobs report and what the Federal Reserve is signaling about interest rates.
Right.
Got two great articles here from AP News and PBS News to help us unpack all of this.
It's always fascinating to see how Wall Street reacts and sometimes overreacts to, even small changes in economic data.
Yeah. Well, let's get right into it.
Okay.
AP News is calling this jobs report the just right report.
Okay.
More jobs were added than expected, which is good news, but the unemployment rate also ticked up slightly.
Right.
Seems a bit counterintuitive, doesn't it?
It does on the surface.
Yeah?
It's kind of like, trying to find that perfect temperature for the baby bear's porridge.
Right.
Not too hot, not too cold.
Yeah.
In this case, though, the market seems to be relieved that the job growth, while strong, wasn't so strong as to overheat the economy and push inflation higher. So that slight uptick in unemployment might actually be seen as a sign that things aren't spiraling out of control.
Okay, so initially, investors breathed a sigh of relief, and the market went up, even hitting more record highs for the S&P 500, as AP News pointed out.
Exactly. A just right jobs report fueled optimism.
Yeah. But then the Fed stepped in with their projections about future interest rate cuts, and things took a turn.
Right.
Both articles highlight the Fed's recent rate cuts, which were meant to stimulate the economy and support the job market.
Yes.
But now they're projecting fewer cuts in 2025 than previously anticipated, according to PBS News.
Right.
Why does that seemingly small detail send the markets into a tailspin with one of the worst trading days of the year?
Well, you see, when the Fed cuts interest rates, it essentially makes it cheaper for businesses to borrow money.
Okay.
This encourages investment and fuels growth.
Right.
Investors were banking on a series of cuts to keep the party going, but the Fed's hinting at tapping the brakes.
I see.
Fewer cuts mean less cheap money sloshing around. And that makes some investors nervous.
So it's not just the actual change in rates, but the change in expectations that really spooked the market.
Absolutely. It really highlights the psychological element driving market behavior.
Right.
Investors are constantly trying to anticipate the future, and when their expectations are disrupted, it can trigger a cascade of selling as they adjust their portfolios. There's an element of fear of missing out and herd mentality at play here as well.
Interesting. So lower interest rates are almost like a psychological boost for the markets.
Yeah, you could say that.
Okay.
When rates are low, there's a sense of confidence and a willingness to take on more risk. But when that easy money environment starts to change, even slightly, that confidence can erode quickly.
And PBS News points out that this sell-off wasn't uniform.
Right.
Smaller companies, especially those reliant on borrowing for growth, felt the brunt of it. On the other hand, companies like Jabil, an electronics company, thrived after exceeding earnings expectations.
Yeah.
What explains this difference?
Well, smaller, rapidly growing companies often have higher debt-to-equity ratios.
Okay.
They need to borrow more to fuel their expansion, making them more sensitive to interest rate changes. Think of it like this.
Okay.
If your monthly mortgage payment suddenly went up because of higher interest rates, it would put more strain on your budget, right?
Makes sense. But companies like Jabil that are performing well and not as reliant on debt can weather these storms more easily.
Exactly. They have stronger fundamentals, which gives investors confidence even when the overall market is shaky.
Right.
It demonstrates that individual company performance can be a powerful counterforce even when the macro environment is shifting.
So while a lot of investors were hitting the panic button, those who were focused on strong companies with solid earnings weren't as phased.
That's right. They were likely focusing on the long-term prospects of those businesses rather than getting swept up in the short-term market volatility.
This brings up a point AT News made about wage growth. They said stronger wages are great for workers, which intuitively makes sense, but it could also contribute to inflation.
Right.
How does that work?
Well, think of it this way.
Okay.
When people have more money in their pockets, they tend to spend more.
Sure.
Increased demand for goods and services can push prices up.
Right.
It's a delicate balance. We want a healthy job market and rising wages.
Yeah.
But if those wages rise too fast, it can create an inflationary spiral.
So we've got this just right jobs report that initially sent the market soaring, followed by the Fed hinting at fewer interest rate cuts,
Right.
which spooked investors and caused a sharp downturn.
Yeah.
What I'm taking away from this is that even subtle signals from the Fed can have a dramatic effect on market sentiment.
Precisely. And it emphasizes the importance of understanding both the macroeconomic trends and the micro-level details of individual companies.
Right.
The market is constantly reacting to new information, and staying informed is key to navigating those ups and downs. Yeah.
Okay. Well, it's fascinating how all these pieces fit together: jobs, interest rates, inflation, and investor psychology.
Yeah.
And on top of that, we have a new presidential administration coming in.
Right.
AP News mentioned that President-elect Trump's stance on tariffs has some consumers already adjusting their buying habits. They're worried about potential price increases.
It's a great example of how political decisions can have a real impact on consumer behavior.
Yeah.
You know, if people believe prices will go up because of tariffs, they might stock up on certain items now,
Right.
which could further contribute to inflation.
Right.
It puts the Fed in a trickle position.
So it's like the Fed is trying to steer a ship through choppy waters.
Yeah.
And the new administration could change the direction of the wind at any moment.
That's a good way to put it.
Yeah.
The Fed has a dual mandate to keep inflation under control and promote maximum employment.
Right.
Tariffs could potentially fuel inflation, forcing the Fed to raise interest rates sooner than they'd like, which could slow down economic growth and potentially impact jobs.
It's a delicate balancing act.
It is.
It makes me wonder what other policy changes might be coming down the pipeline.
Yeah.
And how the markets will react.
That's the million-dollar question.
Yeah.
The markets crave predictability, and a new administration always introduces a degree of uncertainty.
Right.
I think it's safe to say we can expect some volatility in the coming months
Okay.
as investors try to anticipate the new administration's economic agenda.
This all sounds pretty complex.
It is.
But how does it relate to someone who isn't actively trading stocks every day?
Even if you're not glued to the stock ticker, these macroeconomic forces impact everyone.
Okay.
Interest rate changes affect borrowing costs for things like mortgages, car loans, and even credit cards. Inflation erodes purchasing power, making everyday goods and services more expensive.
Right.
It's all interconnected.
So staying informed about these trends is important for everyone, not just Wall Street insiders.
Absolutely. Understanding the forces driving the economy can help you make more informed decisions about your personal finances, even if you're not a seasoned investor.
Earlier, we talked about how smaller companies, especially those that rely heavily on borrowing, took a hit when the markets reacted to the Fed's projections.
Yeah.
Can you elaborate on why those businesses are particularly vulnerable to rising interest rates?
Sure. Many smaller companies, especially those in growth mode, depend on debt financing to fund their expansion.
Okay.
They might take out loans to invest in new equipment, hire more employees, or expand their operations.
Right.
When interest rates rise, their borrowing costs go up,
Yeah.
which can squeeze their profit margins and make it harder to service their debt.
So it's not just about the cost of borrowing,
Right.
but also the impact on their overall profitability and growth prospects.
Exactly. It can create a domino effect. Higher interest rates can lead to slower growth, which can make it harder to attract investors and secure additional funding,
Right.
which can further hamper their expansion plans.
But we also saw examples like Jabil, where a strong company with solid earnings actually performed well, even amidst the market turmoil.
Right. Jabil's success highlights the importance of strong fundamentals.
Okay.
They exceeded earnings expectations, which signaled to investors that they're managing their business well and are less reliant on debt for growth.
Yeah.
It demonstrates that even when the broader market is jittery, individual companies with strong performance and a solid track record can still attract investors.
It seems like a key takeaway for our listener is that understanding individual company performance is just as important as understanding the broader economic picture.
Couldn't agree more. You can't just look at the headlines and make investment decisions based solely on macroeconomic trends.
Right.
You need to dig deeper and analyze individual businesses, their financials, their management team, their competitive landscape, and their long-term growth potential.
So while a lot of investors were focused on the Fed signals and the potential for rising interest rates, others were recognizing the opportunity to invest in solid companies that were weathering the storm.
Precisely. It's about recognizing that even in times of uncertainty, there are always opportunities. It's about staying informed, doing your research, and not letting fear dictate your investment decisions.
AP News mentioned a survey from the University of Michigan that showed consumer sentiment might be improving. That seems a bit surprising given all the market volatility and economic uncertainty we've been discussing.
It is interesting, isn't it? It suggests that the story on Main Street might be different than the one playing out on Wall Street.
Okay.
Perhaps the strong job market and rising wages we discussed earlier are giving consumers more confidence in their own financial situations,
Yeah.
even if they're worried about the bigger picture.
So it's not necessarily a contradiction,
Right.
but rather a reflection of the complex and multifaceted nature of the economy.
Exactly. The economy is not a monolithic entity. Different sectors, different businesses, and different individuals experience economic conditions differently.
Right.
It's important to look beyond the headlines and understand those nuances.
It sounds like what you're saying is that while it's important to stay informed about macroeconomic trends like interest rates and inflation, it's also crucial to pay attention to the individual stories and microeconomic factors at play.
I think that's a great way to put it. Don't get so caught up in the big picture that you lose sight of the individual trees, so to speak.
So to sum up what we've discussed so far, we've got this just right jobs report that initially sparked optimism,
Yeah.
followed by the Fed's hints about potentially slowing down on rate cuts,
Right.
which injected a dose of caution into the markets.
Yes.
We've also explored how rising interest rates can impact businesses differently, with smaller high-growth companies feeling the pinch more acutely,
Right.
while companies with strong fundamentals and less reliance on debt can weather the storm more effectively. And we've touched on the human factor, with some consumers adjusting their buying habits in anticipation of tariffs,
Right.
and others feeling more confident due to a strong job market and rising wages.
Yeah.
It seems like we're starting to get a clearer picture of this complex economic landscape. But before we wrap up, I wanted to circle back to something PBS News highlighted.
Yeah.
How differently various sectors reacted to the Fed's news.
Right. It's a crucial point.
Yeah.
The impact of potential interest rate changes wasn't felt equally across the board.
Right.
As we discussed, smaller companies, particularly those dependent on borrowing for growth, were hit hardest.
It's almost like they were expecting this constant flow of easy money.
Yeah.
And now the tap might be tightening a bit.
Precisely. Imagine, those fast-growing tech startups or companies undergoing rapid expansion. They often rely heavily on debt to fuel that growth.
Right.
Even small increases in interest rates can significantly impact their profitability and ability to manage their debt load.
But then you have companies like Jabil, which not only weathered the storm,
Right.
but actually excelled despite the market dip.
Yeah.
What sets them apart?
Well, Jabil is a prime example of how strong individual performance can make a real difference.
Okay.
They surpassed earnings expectations, and their stock soared. It's a powerful reminder that it's not just about the overall economic climate.
So it's about looking beyond the macro trends.
Right.
And digging into the specifics of individual companies,
Exactly.
their management, their strategies, and how they're positioned within their industries.
Absolutely. It's about connecting the dots.
Yeah.
Understanding how broader trends like interest rate changes might affect specific industries, and then examining how individual companies within those industries are adapting and positioning themselves for success.
Okay, so we've unpacked the why behind the market's reaction. Now, for the so what,
Right.
what does all this mean for our listener moving forward?
Yeah.
What should they be thinking about?
That's the key question, isn't it? First and foremost, don't panic. Market fluctuations, even dramatic ones like we saw in response to the Fed's projections, are a normal part of the investing landscape.
That's easy to say when you're not watching your portfolio numbers drop.
True, it can be unnerving,
Yeah.
but it's important to remember that investing is a long game.
Okay.
Trying to time the market perfectly is incredibly difficult, even for seasoned professionals.
So stay calm, stay the course.
Essentially, second, pay attention to the signals.
Okay.
The Fed's suggestion that the pace of rate cuts might slow is valuable information.
Right.
It doesn't necessarily spell disaster, but it does warrant a bit more caution, especially when considering riskier investments.
It's like those high growth companies heavily relying on borrowing that we discussed earlier.
Exactly. They might be more susceptible to rising interest rates.
Okay.
Third, diversify your investments.
Right.
Don't put all your eggs in one basket.
This is where having a mix of stocks, bonds, and maybe even some alternative investments comes into play, right?
Precisely. Diversification helps smooth out those inevitable market bumps.
Yeah.
Different asset classes react differently to economic shifts. So having a well-balanced portfolio can help mitigate risk.
So far, we've covered staying calm,
Mm-hmm.
being mindful of the signals,
Right.
and diversifying.
Yes.
Any other advice for our listener as they navigate this complex landscape?
Perhaps the most crucial piece of advice is to stay informed.
Okay.
The economic and political landscape is constantly evolving.
Right.
What held true yesterday might not hold true tomorrow. Seek out reliable sources of information. Stay curious, keep learning, and don't hesitate to ask questions.
Yeah.
The more you understand, the better equipped you'll be to make sound financial decisions.
It sounds like knowledge truly is power when it comes to navigating the world of finance and investing.
I couldn't agree more. So stay curious, stay informed, and keep an open mind.
Well, on that note, I think we've covered a lot of ground today.
I have.
We've explored the stock market's roller coaster ride, examined the Fed's intricate balancing act, and delved into the potential impact of policy changes.
We've also highlighted the importance of understanding both the big picture and the finer points of individual company performance, offering some guidance for our listener as they navigate these complex waters.
And if there's one key takeaway we want to leave our listener with, it's that knowledge empowers.
Absolutely.
The more you understand about the forces shaping the economy and the markets, the better prepared you'll be to make informed financial decisions.
Absolutely. So stay curious, stay informed, and as always, happy investing.
Happy investing indeed.